The envelope usually arrives on a Tuesday or Wednesday. It is never sent by regular mail. It comes via registered courier, requiring a signature at the door. It is thick, heavy, and bears the logo of the bank's Special Investigations Unit or Corporate Security Division. When you sign for it, your heart skips a beat. You assume it is a notice about your mortgage renewal or perhaps a letter regarding an interest rate adjustment. But when you tear open the seal and unfold the crisp, legal-sized paper, you are met with a subject line that makes your blood run cold. Immediate demand for repayment due to material misrepresentation. You read the first paragraph, your hand shaking uncontrollably. The bank is not asking for a missed payment. They are not asking for updated insurance information. They are telling you that they have completed a forensic audit of your original mortgage application from 3 years ago. They have verified your employment status with the company listed on your T4 tax slip, and the company has confirmed you never worked there. They have cross-referenced your stated income with the database at the Canada Revenue Agency, and the numbers do not match. The letter concludes with a brutal, non-negotiable ultimatum. You have 30 days to repay the entire mortgage balance of $850,000 in full, or the bank will commence immediate legal proceedings to seize your home. Welcome back to Canada Property Watch. In our previous investigative report, we exposed the great layoff and explained why thousands of bankers, underwriters, and mortgage specialists are being fired across the country. We told you that the banks are purging their staff to cut costs and reduce liability. But there is a darker, more terrifying side to that story that we are only now uncovering. The banks are not just firing employees, they are weaponizing their internal audit teams to cleanse their loan books. They are hunting for the fake files. They are tracking down the billions of dollars in mortgages that were approved based on fabricated documents, inflated incomes, and fraudulent employment letters. This is the mortgage recall. This is the moment when the Canadian banking system begins to aggressively detoxify itself from the synthetic assets that fueled the housing bubble. And for the estimated hundreds of thousands of homeowners who used creative financing or Brampton loans to get into the market, the clock has just run out. To understand the sheer scale of this crisis, we have to talk about the open secret of the Canadian real estate market. In the industry, it is whispered about in coffee shops, discussed in closed WhatsApp groups, and advertised openly on social media under coded language. It is often referred to as the Brampton Loan, though it is by no means limited to Brampton. It happens in Vancouver, in the suburbs of Montreal, in Calgary, and in every hot housing market in between. It is a slang term for a mortgage obtained through systemic document fraud. During the frenzy of 2020 to 2022, the fear of missing out was so intense that normal, but law-abiding people felt they had no choice but to cheat the system. Prices were rising by $10,000 a month. Bidding wars were out of control. A household income of $100,000 could not qualify for a townhouse, let alone a detached home. The stress test set by the government made it impossible for the average family to buy a home legitimately. So, buyers turned to the shadow market of mortgage brokerage. They turned to the fixers. Here's how the scheme worked, and this is exactly what the bank auditors are now unraveling with terrifying precision. Let's create a profile of a typical borrower involved in this. Let's call him Michael. Michael is a hardworking guy. He drives for Uber and works part-time at a warehouse. His actual gross income is roughly $65,000 a year. He has saved a down payment of $100,000. He wants to buy a home for $1 million to secure his family's future. Mathematically, it is impossible. He goes to a major bank branch and he is rejected in 5 minutes. But then, a friend introduces him to a specialist. This broker tells Michael, "Don't worry, we can fix your income. We do this for everyone." It is how the game is played. For a fee, usually 1% of the mortgage amount, in this case, nearly $10,000 in cash, the broker connects Michael with a network of professional document forgers. They create a completely new identity for Michael on paper. Suddenly, Michael is no longer an Uber driver. He is a senior logistics manager at a numbered company that actually exists but has no real operations. And they generate fake pay stubs with perfect deductions for CPP and EI. They forge T4 tax slips that look identical to the real thing, down to the font and the paper quality. They even set up a burner phone number for the bank to call for employment verification, where a co-conspirator answers and confirms Michael's 6-figure salary and his 5-year tenure at the firm. The bank's underwriter, overwhelmed with hundreds of applications a week during the boom, looks at the papers. They look real. The credit score is good. The loan is approved. Michael gets the house. The broker gets the commission. The forger gets the cash fee. And the bank gets a new mortgage on the books. Everyone wins, right? Wrong. This was a ticking time bomb, and the fuse was lit the moment the market turned. Why is this happening now? But why are the banks suddenly digging up files from 3 or 4 years ago that are already paying interest? The answer lies in the bankers fired story we discussed in the last video. When a mortgage specialist is fired for fraud or performance issues, the bank's risk management software automatically triggers a Contagion Protocol. This is an automated system audit. If a banker is found to have submitted one fake file, the algorithm assumes they submitted hundreds. The bank launches a retroactive audit of that employee's entire portfolio. They pull every file they ever touched. But in 2026, they are not checking these files with human eyes. They are using advanced artificial intelligence. They are using optical character recognition, or OCR, combined with pattern recognition software. The AI scans the PDF documents submitted 3 years ago. It looks for metadata anomalies. It looks for pixels that were altered in Photoshop. It detects if the font used on the T4 slip is slightly different from the standard CRA font. It checks if the employer has 20 employees but only one phone line. More importantly, the banks are now using automated APIs to check tax data directly. In 2021, the banks didn't always verify directly with the Canada Revenue Agency because it was slow and they wanted volume. In 2026, they are checking everything against the source. They are prioritizing security over volume. And what they are finding is terrifying. Industry insiders suggest that up to 20% of mortgages in certain high-growth suburbs are based on some level of income exaggeration. We are talking about tens of billions of dollars in fraudulent debt sitting on the balance sheets of the big 6 banks. When the audit team confirms that Michael's documents were fake, they trigger the material misrepresentation clause in the mortgage contract. This is a standard clause in every single Canadian mortgage, usually found in the fine print on page 12 or 13. Almost no one reads it. It states that if the borrower provided false or misleading information to obtain the loan is in default immediately. It does not matter if Michael has never missed a payment. It does not matter if he has a credit score of 800. It does not matter if he is a model citizen. The contract was void from the start because it was based on a lie. The bank sends the demand letter. They recall the loan. This is fundamentally different from a renewal denial. A renewal denial happens at the end of the term, giving you months to prepare. A recall happens now, on a Tuesday afternoon. Michael has 30 days to pay back $800,000. Obviously, he doesn't have the cash. He can't refinance with another major bank because now there is a fraud warning on his internal credit file. The banks share this data through a shared fraud database. If RBC kicks you out for document fraud, TD is not going to take you. Scotiabank is not going to touch you. You are effectively blacklisted from the entire A-lender ecosystem. So Michael enters the panic phase. He runs to the B lenders. He runs to the private lenders. He goes to the sharks. He says, "Chum, I need a private mortgage to pay out the bank immediately." The private lender looks at the house. The value has dropped 20% since Michael bought it. The lender says, "I can give you a loan, but the interest rate is 14% and there is a 3% lender fee and a broker fee." Michael calculates the payments. At 14%, his monthly interest payment alone is over $9,000. Remember, he only makes $65,000 a year. He cannot afford it. He is trapped. The only option left is the forced sale. Michael puts the house on the market, but he is not the only one. Hundreds of other Michaels in his neighborhood are receiving the same letters. They are all rushing for the exit at the same time. They are flooding the market with listings, and because they are desperate, and because the bank has given them a 30-day deadline before they send the sheriff, they are accepting lowball offers. This drives the comparable sales data down further, which pushes more legitimate homeowners underwater. This is the death spiral of the housing bubble. It is not caused by interest rates alone. It is caused by the sudden exposure of the fraud that built the bubble. There is another layer to this audit that is even more dangerous than the bank recall. It is the Canada Revenue Agency audit. In the past, the banks and the CRA did not talk to each other very much. Privacy laws made data sharing difficult. But recently, new frameworks and investigative powers have been activated to fight money laundering and housing fraud. When a bank discovers a fake T4, they are legally obligated to report it to FinTrack and the Financial Intelligence Unit. This report eventually makes its way to the CRA. Now imagine the nightmare scenario. You told the bank you made $200,000 to get the mortgage, but you told the CRA you made $40,000 to pay less tax. You played both sides. You wanted the loan of a rich man and the taxes of a poor man. When the systems link up, the discrepancy lights up like a flare. The CRA launches a lifestyle audit or a net worth audit. They look at your mortgage payments, your car leases, your property taxes, your credit card bills. They say, you are spending $8,000 a month, but you report income of $3,000. Where is the money coming from? They reassess your taxes going back years. They hit you with gross negligence penalties, which are 50% of the tax owed. They charge compound interest. And in severe cases, they pursue criminal charges for tax evasion. We are seeing a wave of these cases hitting the courts. The Brampton Loan is not just a financial risk anymore. It is a legal liability that can lead to prison time or bankruptcy. This crackdown is also aggressively targeting the landlords, the real estate investors who own 5, 6, or 10 properties using the BRRRR strategy: buy, rehab, rent, refinance, repeat. Many of these investors use the rental income offset method to qualify for multiple mortgages. They created fake lease agreements to show the bank that the properties were generating more income than they actually were. They used these fake leases to get more mortgages to buy more houses. And it was a house of cards built on imaginary tenants. The banks are now auditing the rental rolls. They are asking for proof of rent deposits. They want to see the bank statements showing the money actually entering the account from a third party. If you provided a fake lease for a basement apartment that doesn't legally exist, or for a tenant who is actually your cousin, the bank is calling the loan. We are seeing investors with portfolios of $10 million having all their mortgages recalled simultaneously. This is what we call a portfolio liquidation event. When one of these investors collapses, they dump 10 houses onto the market in a single week. This shatters the local pricing in their specific neighborhood instantly. We must also talk about the title insurance aspect. When you buy a house, you usually buy title insurance. And the banks also buy mortgage default insurance from providers like CMHC, Sagan, or Canada Guarantee. These insurers are the ones truly on the hook if the market crashes. They are currently hemorrhaging money due to the rise in defaults. To stop the bleeding, they have launched their own aggressive investigation units. If you default on your mortgage, the insurer usually pays the bank and then comes after you for the loss. But if the insurer discovers that you lied on the application, if they find out you committed fraud, they deny the claim. They refuse to pay the bank. This leaves the bank holding the bag. This makes the banks even more aggressive. They realize that their insurance policies are worthless on these fraudulent loans, so they are moving faster than ever to seize the asset before prices drop further. They are not waiting for you to miss 3 payments. They are using the fraud clause to act preemptively. They are panic selling your house before you even have a chance to pack your bags. This brings us to the human element of this tragedy. Who are the people getting these letters? They are not all criminal masterminds. Many of them are hardworking immigrants, young families, and first-time buyers who were preyed upon by predatory brokers. They were told, this is how everyone does it in Canada. They were told, don't worry, the value will go up and you can refinance later to a real loan. They trusted the professionals. They paid the exorbitant fees. Now, they are facing financial ruin. The broker who sold them the fake documents, he has closed his shop. He has changed his number. He is long gone with the commission. The homeowner is left holding the toxic debt. We are seeing a massive spike in mental health crises in the suburbs of Toronto and Vancouver, directly linked to these audits. Imagine the shame of having to tell your family that you are losing the house, not because you lost your job, but because you committed fraud to buy it. Imagine the fear of going to jail. Imagine the stress of having your bank accounts frozen while the investigation proceeds. The Brampton Loan promised the Canadian dream, but it delivered a nightmare. And let's be clear about the shadow banking sector. For a while, people thought they could hide in the private market. They thought, if the bank kicks me out, I will just go to a mortgage investment corporation, MIC. But the MICs are in trouble too. They borrow money from the big banks to lend to you. And when the big banks tighten credit lines to the MICs have to call their loans too. We are seeing private lenders refusing to renew one-year terms. They want their capital back. The liquidity crunch is hitting every level of the financial system, from the Royal Bank Tower down to the strip mall lender. We are also seeing a new disturbing trend emerging from this. The whistleblower phenomenon. Bank employees who are terrified of being fired are starting to report their colleagues to save their own skins. Tenants who are being evicted by landlords are reporting their landlords to the CRA for tax evasion. Neighbors who are tired of illegal rooming houses are reporting the owners to the banks. Even ex-spouses in divorce proceedings are reporting each other for mortgage fraud to gain leverage in asset division. And the code of silence has broken. The pressure is too high. Everyone is turning on everyone. If you have a fraudulent mortgage, you are not just worried about the bank algorithm. You have to worry about the people around you. One phone call to the bank's anonymous tip line can trigger an audit that destroys your life. The banks are also quietly changing their Know Your Client, KYC, rules to prevent this from ever happening again. They are beginning to demand access to your CRA account directly. In the future, you won't print a PDF of your notice of assessment and give it to the broker. You will have to log in to your CRA My Account through a secure bank portal and authorize a direct data transfer. This will eliminate document fraud overnight. But it will also mean that millions of Canadians who currently qualify based on stated income or business for self adjustments will no longer qualify for any credit at all. The credit box is shrinking to the size of a pinhole. This is the great deleveraging. It is not just about interest rates. It is about trust. The banks have lost trust in the borrower. The insurers have lost trust in the banks. And the regulators have lost trust in the system. When trust evaporates, liquidity evaporates. What should you do if you are watching this and you know, deep down, that your mortgage application wasn't 100% accurate? What if you know that your broker tweaked your numbers or that you signed papers you didn't fully understand? First, silence is not a strategy. Hoping the bank won't notice is a gamble with your entire financial future. The AI gets smarter every day. It runs 24/7. It does not sleep. It will eventually find the discrepancy. Second, do not go back to the same broker who got you into this mess to try and fix it. That is like asking the arsonist to put out the fire. They will only sell you another high-interest product that digs the hole deeper. Third, you need to consult with a lawyer who specializes in real estate fraud and civil litigation. Not a real estate closing lawyer, but a litigator. You need to understand your exposure before the demand letter arrives. Fourth, you might need to sell the house voluntarily before the bank forces you to. A voluntary sale allows you to control the price and the timing. You can stage the home, you can pick the closing date. And a forced power of sale is a fire sale that destroys your equity and leaves a permanent mark on your credit report. If you sell now, you might walk away with nothing, but at least you walk away without a judgment debt hanging over you for the next 20 years. For the rest of the viewers, the savers, the people who sat on the sidelines because they couldn't qualify honestly, this is the vindication you have been waiting for. It is cruel to say, but the market needed this purge. You were competing against people who were cheating. You were bidding against phantom income. You were priced out by fraud. You were told you were financially illiterate because you didn't leverage up using fake documents. As these fraudulent loans are recalled and these homes hit the market, the artificial demand that pumped up prices will evaporate. But we are moving from a market driven by credit to a market driven by income. Real income. Verified income. Tax-paid income. This transition will be painful. It will result in a significant correction in house prices, especially in the exurbs and the investor-heavy condo markets. But it is necessary to restore sanity to the Canadian housing system. The era of the Brampton Loan is over. The audit has begun. There is one final group we need to address: the pre-construction buyers. If you bought a pre-construction home 3 years ago using a mortgage pre-approval based on projected income or working with a shady broker, you are walking into a buzzsaw. When you go to close on that property next month, the bank will re-qualify you using the new strict standards. They will check the documents again. If they find fraud, they will not fund the mortgage. You will lose your deposit. You will be sued by the builder. This is the next wave of the crisis, and it is hitting right now. If you are seeing for sale signs sitting on lawns for months in your neighborhood, look closely. Are they empty? Do they look abandoned? These might be the victims of the audit. The invisible hand of the risk management algorithm is sweeping through the streets, knocking on doors, and asking for the receipts. In our next video, we are going to investigate that specific crisis, the pre-construction collapse. We have talked about people losing the homes they live in, but what about the 100,000 Canadians who bought condos on paper that are now worth less than the mortgage they need to close? By Marus, we will expose the appraisal gap that is about to wipe out billions in deposits and trigger a wave of builder bankruptcies. Subscribe to Canada Property Watch. We are tracking the collapse from the inside out. We are reading the fine print that the real estate agents ignore. We are watching the courts, the audits, and the foreclosure lists. The party is over and the cleanup crew has arrived, and they are not here to negotiate. They are here to collect.